the ride-sharing platform Didi. Okay, we've talked about that in the past, so we're not going to beat that dead horse there. But China regulatory crackdown, stock just absolutely tanked after IPOing. Okay, if you pull up, so now we always give this grain of salt with 13Fs. 13Fs are the filings that managers have to do with if you have over $100 million in assets. The lag there, or the big grain of salt that you must take with this, is that you don't know for sure if they still hold these positions. So a lot of these came out on the 16th or 15th was their last day to file for the quarter, but they could, just because it says they own XYZ, maybe they don't own that exact same amount or at all now because there's a gap. There's
especially
a lag
high
there.
Frequency funds. And probably most of that stuff they're
well, out of. Anybody can do it. Anybody can trade at any time.
But
some
usually
more
you
than
can
others,
find
yes.
out who's doing that, right? I mean, you can look at like the Soroses and
right.
Elliott Management. I mean, you can look at some of these guys and say, okay, these are low turnover. They'll buy Berkshire and they buy it and they add over time. So yeah.
But I say all that to say this, because you look at respectable, very successful managers. So Dan Loeb, Third Point. Paulson and Company, John Paulson, Tiger Global, and George Soros Fund. All of them had new positions in Didi. A couple million shares to several million shares over the last reporting period. Now, if you pull up a chart and see the volatility and all that, it wouldn't shock me to see several of these to trim these or close these positions out the next time they file for these 13Fs. I'm not saying that. It's just something that caught my eye when I'm looking through a lot of these. It's like, man, what are fund managers looking at? What are they buying? Are they buying the same thing? It's just kind of a fun data point to look. So that's something I'll be looking at next time. Because 13Fs are out. Anything catch your? I've been wanting to ask you about this. What caught your eye with 13Fs, if anything? Because I got a few.
With Soros too, and guys, this is important to look at because I like looking at this, and I cover this all the time. But I'm always aware that we get new listeners all the time. For these 13Fs, well, the biggest funds in the world. Anyone will imagine over 100 million, but everybody. The billions and the trillions, they all have to report their holdings, whether they are, at the end of the quarter. So top new buys, top exits, what they're boosting their positions and cutting stakes. And again, like Daniel said, it could change. But for me, I like looking at things that just like catch my eye. And one of the things that caught our eye, which I think we're still up on, we did well on, but, we just recommended it. But, it was a stock that was that I hated for a long time. And you'd never see show up. It's kind of a small cap name that's gotten beat up. And David Einhorn was buying it. And not that I pay attention to David Einhorn exactly what he's buying. I just, he's a big name, someone that I look at. And that name showed up and it made me research it. And I researched the company changed model completely. So for me, I look at these things and see who maybe David Tepper is buying and not necessarily saying, hey, he bought this, I'm going to buy it now. But I like to see like the trends in what he's doing. So some of the things that caught my attention here, Appaloosa, he cut stakes in the major technology companies. Alibaba, which is fine, but Micron, Facebook, Google. Cutting your stakes in that. He was very early. I don't want to say very early because, if you bought these things 3 years ago, it's not early. But, he was going all in on a lot of these names, and to see him get out of those names, I thought that's interesting because those are names that are really holding up the market. Guys, I don't know if you're seeing what's happening to small caps. I didn't recommend a small cap for the first time, Daniel, maybe in like over a year. In Curzio Venture Opportunities, and because it's just so volatile and during earnings season, it just wasn't a good risk reward. And sure enough, we're seeing a lot of names within that sector get nailed on no news. A lot of risk coming out of the market. But when I see something like this in Appaloosa, and not just them, but several big high-profile fund managers are selling out of the bigger names. Again, that can mean nothing, that can mean something. But a lot of these names are the ones that have been holding up this market, and the fact that they're getting out probably means that they think the market could come down a little bit. Something to think about. I thought it was interesting with Carl Icahn, where he has 17 reportable investments, but I've never seen this before. It's a new undisclosed position in an unnamed stock. So that's something that doesn't happen, but he took an unusual step that requires a separate filing with the SEC, Securities Exchange Commission. So you don't know what, but if you want to provide interest in the stock, that's the way to do it, right? Because when that comes out, people are going to be like, holy shit, let's buy it. And he's in
Is he on our marketing team? That's a great tease. How did he do that?
That's an awesome tease. Good for him. He's so smart. Anyway.
Hey, go ahead. Sorry.
No, and the biggest news, I think, was Michael Blurry just saying that he's, shorting Cathie Wood. Own puts on Ark Innovation ETF. He increased its Tesla puts, and, Michael Blurry, big short and stuff like that. Again, he was early to that and then made a fortune. It's something to think about. A lot of people are against Cathie. Me, I have nothing against her. I think it's remarkable of how her funds performed. Everybody is all over her, but you know what you get with her. She is about innovation, getting into stocks that a lot of people won't get into because they're very, very expensive, and that has worked for a long time for her. So I wouldn't take it as all these stocks that she's in are going to crash and Michael Blurry's right, because Michael Blurry was very, very wrong before he was right, unfortunately, but he still worked out for him tremendously, which is usually the case when people get a big idea right. Then the timing is tough. Usually it takes a little while and then boom, holy cow. But it is something to pay attention to, I think. But I'm not going to short Cathie Wood at all. I think a lot of these names are a little bit crazy that she does add to and get into. But hey, you know what? She's done a fantastic job pretty much so far with all the volatility. But those are just a few of the things that caught my attention. Guys, this is where you get a lot of ideas, lots of different things. Elliot also, largest purchase of the quarter include 3 million share buy of Twitter. We've seen Twitter doing pretty well. And, they were on the board and things like that. So just little trends like that I like to see. And if things pull back or something that they're buying where I know, David Tepper is not just going to take one position in the stock and then just leave it there. He'll add over time. So new positions that come up, if I see that stock come down 10, 15% or have a bad quarter, I might look to jump on because I know that David Tepper is probably going to add to that position because he just doesn't take a position just like Buffett and you're done. It's usually add to over time and building that position because, a lot of these guys have, a lot of money in the management. Yeah,
absolutely. The thing that keeps getting my attention with Carl Icahn is that he owns over 17% of Xerox. I think it's over 30 million shares.
Added to his position, too.
And he added to it. Mm-hmm. And I admit, I don't know why. But I almost want to buy it just because it's like, hey, I look at the presentations. Margins seem to be improving. They don't have any debt worries. I get that they fill a need in a lot of businesses. I think COVID helped them in certain aspects where, a lot of people need services since they're working from home and they're kind of transitioning from offices and you got that hybrid, work from home situation. But that's something cool that makes me want to dive in a lot more and go through some more. What am I missing or what is he seeing that I'm not? But that's a big takeaway from these 13Fs. Frank, like you said, these are starting points. You want to find ideas, but I'm gonna share a quick story and then what caught my eye. So Dan Loeb, a third point. I noticed he had a position in Upstart a few quarters ago. I forget exactly when it went public, but I believe he was an investor before Upstart went public. And Upstart is a company that uses algorithms and artificial intelligence, AI. Like you always say, Frank, great trigger words to get marketing and things about that in your stock. What it does is it helps loans be more efficient for like banking for mortgages and things. So they basically go into banks, and I'm dumbing this down here to my level, but they go into banks and show through pilot situations, hey, if you use our software and our products, you could have made X number of more loans and had a smaller default rate. Well, if you're in the loan business, if you can loan out more money and have less go bad on you, that's obviously something you want to do as much as, as often as possible. They've had tremendous success. They blew away earnings as far as from the growth perspective recently. Dan Loeb did not change anything. His fund, almost 10% of his fund, and he's got how many billions of dollars under management? Almost 10% is in Upstart, and he maintained the entire position. Mm-hmm. If that isn't a gut check moment or conviction, Frank, I don't know what the hell is.
And speaking
of
massive. Speaking of third point too, Daniel, top new buy for them, Peloton. And It's interesting they say Peloton. I bought a Peloton, but I did cancel the subscription. So I was using it, and then I canceled the subscription.
Cheapskate.
I can't believe it. It's like $4 a month or whatever it is. However, I did because we use United Healthcare. So we said this to all of our employees that they signed a deal with United Healthcare that you get 1 year of the service for free, which is $4 a month. Oh. And that's pretty big. That's big. It's going to result in more people using it, maybe a few more people buying it.
How about that?
But just different things like that I like, I'll see certain things. I'm like, oh, that's pretty cool. And then third point, buying Peloton up here.
Yeah.
Right? I would think Peloton is really expensive stay-at-home stock. And maybe, again, we get a little bit of stay-at-home action for a month or whatever with Delta. But I thought that was fascinating. And real quick, guys, in my last point, well, actually, it's the first point I made. When you're looking at some of these, Appaloosa, which is David Tepper. So I said that, he cut his stakes in Facebook and Google. You're looking at Glenview Capital, top exit, Microsoft on that list. If you're looking at Maverick Capital, cut stakes in Amazon and Google. So you're seeing this, it's not just like one or two people here. You're seeing it a lot. I think Pershing Square boosting its stake in Domino's Pizza, I thought was very interesting. So you're seeing money come out of these bigger names, which is, to me, I just find that's interesting. I mean, this has been their safe haven. It's supposed to be a safe haven. They did fantastic on these names. But these are the names that have been holding up the market. The Apples, the big technology stocks, the $1 trillion market caps that account for whatever, 20% of S&P 500, 18%, whatever that number is. but you're seeing some of the best investors come out of those names, maybe expecting a pullback. There's no way those companies pull back and the whole market doesn't pull back, because underlying those trends, you're seeing more lows than highs, even on days where we're near the record highs, which is pretty crazy. That's not a favorable sign. It's not a healthy sign for the markets. And, you know, being in the small cap world and seeing some of these names that reported, all right, maybe not so good quarters go down 30%. I'm like, holy shit, where did that come from? I mean, we recommended a stock that was down 50% already with insiders buying. They reported a quarter, earnings were bad. They said that the revenue would stay the same and they had problem labor shortages, and that thing freaking crashed on us and we stopped out. And that's something where, you know, look, I cover my losers more than winners, but you have to look at that and say, it wasn't just an isolated situation. I've seen other names now that are not in a portfolio that are getting crushed. And Dan, you covered some of those too, where you say, hey, did you see this one? Did you see that one? And just some of the names, especially, you know, ESG and things like that, which are down tremendously now. And no one's really talking about that. But those are the underlying trends of the market where, hey, you look at the S&P 500, that's what you read. That's higher. The Dow's doing well. Again, a little bit off its highs, but when you're looking at small caps and even some mid caps, a lot of names are starting to get hit, especially ones that don't have pricing power.
Yeah, and going forward, you know, and that thesis is playing out. You can never gauge the volatility 100% correctly, but, you know, a lot of this that's happening, we knew that was happening. Obviously, we got stopped out of a position last week. You know, we didn't see that coming to that extent. But, yeah, that's what we need to pay attention to forward. But, you know, dig through the 13Fs, guys, as individuals out there, because you can learn a lot. You can start to see patterns, get new ideas. Just Whale Wisdom is a great free site that you can basically type any ticker and or hedge fund manager in, see what their most recent filings are about. So dig through all that kind of stuff. One last thing, Loeb did add, he went from 1 million shares to 14 million shares in Intel. I only bring that up because it does make me feel good. I'm still down a little bit on the position. But when you left the entire company in my hands for 2 Fridays, for frankly speaking, I talked about how Intel I thought was just low-hanging fruit. They had a decent quarter with reports, but there's just a lot of momentum going on behind that name if they just don't continue to kind of drop the ball. How's that for a simple investing thesis, Frank? Just don't keep screwing up like you have, and your stock will probably double. Anyway, but you know, that conviction buy, adding that many shares is a big deal.